Hey, this is Shelby with Lusk Mortgage Group. Welcome back to 120 Days Home Buying Online. We are on week 7 currently, and this week what we're talking about is government loan products. Government loan products are going to consist of FHA loans, USDA loans, and VA loans, okay? So we're going to talk about how you might qualify for those, what maybe the restrictions might be, and that way we can forward plan if those one of the loan options you're looking for, maybe what that scenario would have to look like. But let's start with FHA loans, as that's one of the more common ones and maybe one you've heard of before. But FHA is the Federal Housing Administration. It's backed by HUD, so it is backed by the government. Now what that means is that there's a little bit more leniency in some of FHA's guidelines. For instance, you're able to have a credit score of 580 or higher. Some banks will go lower than that, but that is with stipulation. Now also, when we're looking at your debt to income ratios on an FHA loan, usually have a little bit more leverage for a little bit more buying power. Meaning, if, as we've talked about in the past with conventional loans, usually we're looking at a debt to income ratio of maybe 41%. Okay, well, for example, that exact same scenario, FHA may allow you go up to 51% debt to income ratio, which will give you maybe another $10,000 worth of buying power to purchase a home, depending on your situation. Some great things about FHA loans is that they are assumable, meaning that in our great market we have right now, where interest rates are still in the 4s and the 5s, if we were to look 5 to 10 years down in the future and interest rates rise as we're expected to, someone might be able to come in and assume the remainder of your note and go get a second loan for the remainder of what you're selling the home for. It's just an extra advantage when you go to sell the home in the future. Another thing with FHA is that interest rates by standard are less than what you see on a conventional loan. Now there are some different weighing factors that kind of calculate into that, one of which being that FHA does charge a 1.75% of your purchase price, and they finance that back on top of the loan. Now that's your insurance policy that goes to HUD, right? In case of foreclosure or default, that is what backs the loan, so that way the servicer of that loan can get the funds back if you do have to foreclose or something of that effect happens in the future. Another thing with FHA loans is that you do have monthly mortgage insurance. Now monthly mortgage insurance is calculated in the effect of 0.085, which is a small actually mortgage insurance amount in comparison to what we might see on some conventional loans. Now with that monthly mortgage insurance is going to stay on the loan for the life of the loan. If you decide to refinance into a conventional loan product later on, is an opportunity to get rid of that mortgage insurance if the scenario allows. But just keep in mind that mortgage insurance will always be there on that FHA loan. Okay. Now let's talk about USDA loans and maybe what the difference is between that and what an FHA loan is. Now USDA is a rural development loan, so there are specific areas of the country that are going to be allowed to use USDA financing and some areas that are not. Now there's a very quick way to check that eligibility, and you can just go to the USDA's website and enter in that address and see if the property is eligible. USDA does have an income restriction as well. Now it is per county, so it's another thing we want to double check, but usually a 2-family home, we're looking somewhere between $64,000 to $78,000 annual household income for eligibility for that loan product. Now USDA is great in the fact that it allows for a lower credit score as well. By standard, USDA is looking for a 640 credit score, but again, there are stipulations that allow you to go down to a 580 and sometimes even lower. USDA is very forgiving as far as credit history goes, as long as we're showing that we no longer have collections and we've done some credit building, that they're very flexible in that nature. Now FHA, like we were talking about how they have an upfront mortgage insurance, USDA does as well, but theirs is only 1%. So it's a little bit less than FHA. Now given when we're looking at a rural community, you are looking at usually lesser taxes. The mortgage insurance is going to be a little bit cheaper there as well. Their actually monthly mortgage calculation is based off of 0.035 instead of the 0.085. So it's a little bit less expensive of a loan product altogether. USDA, by the way, does allow for 0 down. So that's a great benefit for you if you're looking in those areas to explore a USDA loan option. Okay, those loans are assumable as well, just as FHA loans are. All right, lastly, we're going to talk about VA loans. VA loans work in a very similar fashion as USDA and FHA loans do, as all government products are really factored together to give a lot of the same results. Now, the great thing about VA, now these are restricted to our members of the military, such as a veteran themselves, someone in active military. Different branches are going to have different requirements, so make sure that you check with your commanding officer or reach out to a mortgage lender to talk to them about what your eligibility might be. We can request what's called a certificate of eligibility. Will let us know if you're eligible for a VA loan, if you have a funding fee and what that funding fee amount's going to be, and what your entitlement amount is as well. And that'll factor into what you might be approved for. Now with a VA loan, that does allow for zero down as well. Now if we're putting funds down on that, that will affect what your funding fee is. So that's something to talk to your mortgage lender about to make sure that what you're putting down is a benefit for you as far as your funding fee goes or monthly payment and so on and so forth. Now VA loans are assumable as well, as long as that person qualifies for a VA loan. So there's another added benefit for you as well. Now with VA loans, most banks are looking for a 620 credit score. However, they do have the stipulation where you can go down further than that. We see loans with 580s quite frequently, and some banks will go slower than that as well. Again, that'll just be dependent upon what their stipulations are for that loan program. Now with the VA, if you have a spouse that you're looking to purchase that home with and you're not yet married, it's a common factor, or common question I should say, if that's okay. Now when we're looking at a VA loan, the veteran themselves qualifies for the zero down. But if you're adding a significant other or something like that you want on the loan with you, they still have a portion that is a down payment requirement. So we might explore the VA loan option, or you might need to look at a different option depending on what that situation is. Now, thanks so much for tuning in with us, folks. If you have any questions, feel free to private message us or comment below, and we'd be happy to get back to you. Thanks so much for tuning in. We'll see you next week.